It's Friday, 11th of April, and this is your Capital Economics Weekly Briefing. My name's Neil Shearing, Group Chief Economist. David's out this week, so I'm in the hot seat, but I'm delighted to be joined by Mark Williams, who's our Chief Asia Economist, and Jenny McKeown, who's our Chief Global Economist. Hi, Mark. Hi, Jenny.
Hey, Neil.
Hi, Neil.
Now, where to start with what's been yet another tumultuous week in macro and markets? At the time of recording, the long end of the US Treasury yield curve is looking slightly worrying, yields edging up. We've written lots about this over the past few days. I'll link to all of that analysis in the show notes. But I think we should really spend our time focusing on tariffs and the escalating trade war between the US and China. We've just had news from China that tariffs are going up on US imports from the US, now at well over 100%. And of course, although the US has rolled back its reciprocal tariffs on other countries to 10% for a 90-day period, it's pushed up its tariffs on imports from China to over 145% now. So this is now looking like a US-China trade war rather than a global trade war. But Mark, what's driving the response in Beijing? Clearly, they're not taking any of this from the US lying down. Why do you think that might be? And walk us through what's just happened over the last few hours.
Yeah, so as you said, the US has a tariff of about 145% on everything it buys now from China, but China's tariff is 125%. It's still, it's colossal. China has hit back like for like with every tariff that Donald Trump has introduced. I think it's clear that China is not particularly eager to settle. I think there was potentially kind of an off-ramp here if China wanted to take it by not retaliating again. But instead, China is saying clearly that it will fight back. It will not cede anything to Donald Trump. There is something in the statement from the State Council, which came out just a couple of hours before we're recording this, that China will not play the tariff numbers game anymore. That's the quote from the statement, only because they say that with tariffs at this level, then they essentially become meaningless. There's no point raising them any further. So again, from the statement, it says there is no possibility that US goods will be accepted in the Chinese market with tariffs at these kind of rates. But it's not suggesting that's as far as it will go, because it's also saying that China will continue to retaliate in other ways. So it absolutely is not an olive branch from Beijing. If Donald Trump does want to lower the temperature, the message that they're sending is that he's going to have to take the first move. But yeah, it's pretty combative stuff, really. It's clearly a very different approach than I think pretty much every other government has taken to Donald Trump, where people have generally been reaching out to try and find some sort of a deal.
Why do you think that might be? Well, clearly you're right. In the case of Europe, we had those tariffs. They finally got around to putting some tariffs on some imports from the US in response to the steel and aluminium tariffs that were announced by the US a few months ago. Then they took those back off. So clearly trying not to escalate the situation with the US. The UK has said that cool heads must prevail, but China's taken a very different approach. Why is that?
So I think there's probably a couple of things. One of them, I suspect, is that Xi Jinping does not believe that a deal essentially that Donald Trump can be trusted to stick with any deal that China does with it. And China maybe feels that it's in a bit of a different position from the EU, say, that China has believed for a very long time that it is the enemy. The US is trying to contain China, trying to stop China's rise. That goes back a decade. I think that view is very well rooted in Beijing. And so just does not trust Donald Trump, and particularly seeing the way that policy has moved around so rapidly. I suspect that the fentanyl tariffs that came in before Liberation Day, China had already been hit with 2 rounds of tariffs by Donald Trump this year, and they were under the pretext that China should be doing more to prevent fentanyl imports into the US. I think China just sees that as a completely made up pretext, and that maybe gives the sense to Beijing that, even if they did some kind of deal now, that Donald Trump could always come up with some other reason to put tariffs on them at some point in future, and perhaps is likely to do so given the animosity that there seems to be between the two sides. So politically, Xi Jinping, I think, probably does not want to sit down with Donald Trump or to agree some sort of deal that ultimately could be rolled back a week later, a month later, a year later. And that politically wouldn't look very good for Xi Jinping. An ally to that, though, I think that China looking at the chaos really of policymaking over the past few weeks from the US, is probably thinking to itself that Donald Trump will be much more keen, much more eager to do a deal in a couple of years' time. Because although this is definitely going to hurt China's economy, it's not an existential threat to China's economy. They will get through this. There will be some policy easing. Growth will be slower than it would have been, but it's not terrible. Meanwhile, I think that they probably feel that in a couple of years' time, we've got the US midterms coming up. If these tariffs remain in place, then prices are going to be higher. And there's clearly just a lot of political dysfunction, I think, from Beijing's perspective going on in Washington. So at some point, Trump is probably going to come and be really keen, I think Beijing feels, for a deal. So let's wait until he's really desperate, and then we'll get a better deal out of him. So in that way, I don't think there's a meaningful deal to be done. I don't think China is going to come to the table and offer anything meaningful for the time being. There is a possibility of a partial rollback of the most recent tariffs that have been put on in the past few days. But I think that we're still going to be in a situation in 3 months, 6 months, a year's time in which China is facing some really hefty tariffs on all of its goods to the US. Maybe not the 145% that's there at the moment, but still extremely high.
Yeah, and you mentioned that this is not an existential threat to China's economy, but it's going to surely deal a pretty hefty blow, isn't it? The statement from the Chinese government saying essentially that it's anticipating that all imports from the US will essentially go to zero. What impact does this have on China's economy? Walk us through the kind of channels through which it has an effect and how the policymakers respond. Surely if there's more fiscal support coming, I imagine maybe some monetary support. What happens to the Chinese currency, the renminbi? That's the other critical factor here, isn't it? That so far it's been stable. It's weakened a bit over the last few days, but presumably further falls ahead.
Yeah, so with a tariff of 145%, we think that we're probably looking at a fall in China's exports to the US in the region of 80% or so over the next 2 or 3 years. These are very rough numbers. We're very much in uncharted territory here, but that's, I think, a plausible sort of number. Some people think it could go further. And as you said, the Chinese statement earlier, it seemed to imply that in the other direction, imports from the US could essentially go to zero. I don't think actually that is likely to be the case in either direction, because for many products on both sides, there aren't alternative suppliers. So if you think about firms in the US, many of them will be dependent on some products from China for some of their processes. I think it's an underappreciated fact that actually China's exports of consumer goods are well under half of what it exports. Most of what China exports to the world is machinery and inputs to industry. And so there will be many firms that are dependent on things coming from China in order to produce their products. And we saw during the pandemic how desperate companies became to just get their hands on often relatively low priced inputs. So I think in many cases, people will be willing to pay twice the price, even 3 times the price for certain goods. So I don't think exports to the US are going to go to zero, but really big falls. We're still talking 80% fall over the next 2 or 3 years. We think that will lower China's GDP by more than 2%. As you say, there can be some offsets, a weaker currency. We've already seen just this month already, China's currency has weakened by about 2.5% in trade-weighted terms, which is a lot for China's currency. We're likely to see looser fiscal policy. In fact, they already had lined up some looser fiscal policy in their budget announcement, which came last month. So there will be some offsets, but if tariffs remain at these kind of levels, I don't think that they can fully offset that. So we'd still be looking at China's GDP maybe by the end of next year being 1.5% lower than it would otherwise have been.
And just on our China activity proxy, that presumably means that growth this year is somewhere in the mid-3s. Is that right? Somewhere around that level?
Yeah, that's if tariffs remain at 145%. If they get rolled back a bit to still high, but clearly lower than 145%, where our central scenario has been actually since the day after Donald Trump's election that China will be facing a 60% tariff on exports to the US. And that's still quite a rollback from where we are now. But if that happened, then yeah, we'd be looking at actual growth on the ground in China, perhaps closer to 3.5%, 4%.
Yeah, and obviously challenges that come alongside that for the Chinese leadership. Jenny, let's talk about the global fallout from all of this. So we now have the world's two largest economies really going at each other on trade, potentially US exports to China falling to pretty much zero. Maybe China's exports to the US don't fall to the same extent because of, as Mark says, the more intermediate goods and difficult for those to collapse altogether. What's the global fallout in terms of this US-China trade war? How should we be thinking about that?
Well, it's quite difficult to think about given the turmoil that's going on in financial markets, falls that we're seeing in business confidence at the same time. And the impacts of all of this will depend not only on the extent to which China and the US's exports fall, but the extent to which that affects global markets, the extent to which that goes on to prompt a tightening of financial conditions, and so on and so forth. And at the same time, we've got to think about how much the renminbi might weaken in response to this, how other currencies might respond. Because remember, we still also have this 10% universal tariff in place, which is easy to forget, given how fast things are escalating between the US and China. But it's not just US and China. We have this additional 10% tariff with the threat of more to come after this 90-day pause. So there are lots of different channels to consider, in short.
And when you put all of that together, I know we've got this tariff impact model that we're going to be launching over the coming days. What's the overall kind of order of magnitude hit to the global economy from all of this, do you think?
Yeah, okay. Well, our new tariff impact model, which we've affectionately named TIM, lets our clients design their own tariff scenarios. So given all this uncertainty, people have different views on just where we're going to settle. As Mark said, there's some chance of rollback to come. Our clients with this model can design their own scenarios and model the impact on GDP in economies around the world, as well as on the US average tariff rate and then the price level. Of course, there are inflation effects to consider here too. We've, to help our clients out, we've put 3 different scenarios in which we think are feasible ones. Now, our base case has been that we get a rollback on China such that we end up with a tariff of something like 63%. That might seem a bit optimistic at this point. And that we end up with kind of the reciprocal tariff of 10% plus the steel and aluminium and the auto tariffs, which we already know about. Now, in that scenario, we think that would knock about 0.4 percentage points off world GDP growth, and that's relative to a pre-tariff type scenario that we might have been looking at last year. So that's a significant hit for world GDP. You know, it's not often the world GDP growth slows, but to that extent. But it doesn't really leave you in recession territory, something just below 3% growth. But then we've thought about other scenarios too, one where the China tariff stays at 145%. That's what we've called a liberation light scenario. And we get slightly higher reciprocal tariffs in the end. So this pause does amount to a pause on tariffs on other economies around the world. And we end up at something a bit higher than the 10% reciprocal. We've assumed something like 17%. In that scenario, then world GDP is obviously hit a bit harder. We think that would roughly double the impact. So you'd end up with something like a 0.8 percentage point reduction in world GDP growth relative to the pre-tariff outcome. In that case, you'd end up with world GDP growth down at just above 2% on most definitions. You would think of that as a global recession, as being recessionary territory. So again, 0.8 percentage points off, that might not feel huge, but given the normal fluctuations that you would anticipate in world GDP growth, it is big and would feel like a very difficult few years.
Yes, indeed. I think one of the messages that comes out from some of our analysis here is that if you model the direct effect of tariffs, clearly no one wins from higher tariffs, but if you model the direct effects of higher tariffs, they're not that substantial in terms of global GDP. Clearly, if we had tariffs set at 50-60% for all economies, then that would have a big impact on global output. But at these kind of levels, you don't get a disastrous impact on global GDP. It's more the indirect effects, as you say, the impact on uncertainty and what that does to consumer and business spending. and decisions over future investment, and also what's happening in global financial markets as well, tightening of financial conditions, widening of credit spreads, all of that feeding through into the real economy too. And obviously that's very difficult to get a handle on and extremely uncertain. But the direct effects, at least, I think perhaps not quite as extreme as some reports have suggested. Mark, let me just turn to you to round things off. We've written a lot, haven't we, in the past about what we've called US-China fracturing, the idea that the era of hyper-globalization's in the past, and that the world's kind of splintering into two blocks, one aligned with the US, another aligned with China. Now we have the US and China going at each other's throats in a trade war. How does the developments over the past few weeks fit into this framework around fracturing, do you think? Is it still the right framework to be thinking about?
One common feature of all of the scenarios that we've mapped out for how things could play out over the next few months is that China faces much higher tariffs in the US than everyone else. Even in our relatively optimistic base case scenario, we still think China would be facing a tariff of about 60% compared with 10 or 15% on other economies. So there's been a huge amount of uncertainty, reversals over the past couple of weeks. But what I think is now emerging, as some of the dust seems to be settling, is that China is the main target. It's been chaos in many ways, trying to keep up with everything. But that, of course, is a common thread. This is not new. This is a thread that goes back to the first Trump administration. It continued through the Biden presidency. China is the US's main geopolitical adversary. So that clearly is, that rift between the US and China is really evident now. I think what's less clear is whether all of this also creates a rift between China and other countries or drives them closer together. Because China clearly hopes to use this opportunity to create closer ties with other countries. It's been engaging a lot of diplomacy recently, having low-level trade talks with lots of different countries. But at the same time, we've also seen most other countries are doing what they can to stay close to the US. So one striking example of this recently is India, which traditionally, of course, has been unaligned. It's been a non-aligned power. A few weeks ago, the Indian government was rolling out the welcome mat to Tesla to come and invest in India. And then this week, India's Commerce Minister confirmed that BYD would not be allowed to invest in manufacturing in India. That seems to be emblematic of the way things have been going recently, where countries are eager to do everything they can to buddy up with the US. A big factor there, I think, is the desire to avoid reciprocal tariffs from the US. But I suspect there'll be something else that will be happening over the next few years that will push in the same direction, which is that if the US maintains high tariffs on China, I think other countries increasingly will also be looking to protect their own domestic markets from increased competition from Chinese manufacturing, because Chinese manufacturing is facing this huge excess of domestic production capacity relative to China's own demand. That's already been flooding the global market over the past few years. China's trade surplus hit about $1 trillion last year, has surged just over the past few years. And now the US market, the biggest single market, is being locked off. So those exporters will be looking to find new markets or to increase their market share in existing markets. Excess supply implies that the prices of a lot of Chinese goods will fall even more. They've been falling substantially over the past couple of years. So China's going to be an increasing competitive threat to all economies, I think, over the next few years. And perhaps one legacy that will last from all of the ups and downs of tariffs of the past few weeks is a sense that tariffs are a viable form of policy. That used to be a bit of a taboo, didn't it, to stick tariffs up? But I think tariffs will become much more normalized as an element of policy, and many more countries will perhaps be putting them up over the next few years to protect themselves from China. So that will then cement, I think, this rift that if that happens, it will not just be between China and the US, but China and potentially a lot more countries as well.
That was Mark Williams and Jenny McKeown picking through the bones of what's been another tumultuous week in global macro markets. I'll be back next week with David. I'll also link in the show notes to that tariff impact model that Jenny was talking about, as well as our work on global fracturing and our geoeconomics page, where you can find all of our analysis of this unfolding global trade war, but also how geopolitics is interacting with the global economy. For now, though, goodbye, and we'll speak to you next week.